is no free lunch. If you want the rewards that an NVIDIA brings, you have to be prepared for the risk and the volatility.
So let's start off with one of them that is front and center here. NVIDIA is kicking off its annual GTC event this week, but will it be a catalyst to put shares back on an uptrend? Our Christina Partsinevelos is following the money for us, and this is a stock over the last 10 days, Christina, that by my count here has shown an average trading volume in the last 10 days of over 337 million shares per day. This could be a potentially big catalyst.
Yeah, well, seasonality suggests that NVIDIA shares typically rise in the weeks leading into the event. So to your point about volume, while the relative performance post-GTC, and that's the concerning part, consistently lags. And this year, much of the products from Blackwell Ultra to co-packaged optics are largely expected. It seems to be in every single preview out there. But you have tech stocks, notably semiconductors, really not trading on fundamentals today. Cantor Fitzgerald says they're not sure Jensen can really say anything that would completely shift the market course and overcome investor fears about the macro and geopolitical uncertainty, specifically tariffs. Mizuho bets the stock is going to stay range bound, which we've seen for NVIDIA just up until maybe May earnings. That's what their bet is. Historical data, though, from Wells Fargo reveals a striking pattern. NVIDIA has outperformed the SOX index, which is the chip index, by 6.5% on average during the week of GTC over the past 5 years. So that would be this week. So possibly more gains in lay. But in the gains, though, as you can see, do not last. Looking at 1 month from now, the average return post-GTC for NVIDIA sits at negative 1.6%. Another concerning sign is NVIDIA shares are close to a technical death cross when a short-term moving average like the 50-day crosses below the longer-term moving average like the 200-day. So that would be the blue and yellow lines crossing on your screen. The stock, though, enters GTC week with one notable advantage. Of course, lots with products and all that, but shares currently trading at a valuation discount. You can see a forward P down about 27 times, which is rare for NVIDIA at the start of a product cycle and could be an attractive entry point given the company's continued revenue growth trajectory. It just depends on what narrative you're going to believe. Dom?
All right, Christina Partsinevelos with the preview of what's going to happen with NVIDIA this week. Thank you. And by the way, NVIDIA CEO Jensen Huang will be sitting down exclusively with our own Jim Cramer this Wednesday at 10:15 a.m. Eastern Time. Must-watch interview there on the current state of artificial intelligence. Meanwhile, Joe, you're also looking at NVIDIA's performance after the event as well. What exactly are you keying on, and what exactly do you think we could see in terms of the upside or downside and some of the volume that goes along with it?
I think the important thing for NVIDIA is, can it escape the macro? Can it overcome the macro with what it's going to say? It's going to be a very clear message. They're going to talk about Blackwell Ultra. They're going to talk about the AI platform moving forward, just like they did with last year's conference talking about Blackwell. And the message clearly is going to be, keep spending on our chips. But if we go back and if we could, if sunny Englewood Cliffs, New Jersey could pull up a chart of NVIDIA last year at the GTC conference, you'll see from the middle of March at the initiation of the conference until the middle of April, the stock rallies after the GTC conference about 8%. And then guess what? The macro gets in its way. And I fear that's exactly where we are right now with NVIDIA. They've already alleviated the concerns surrounding DeepSeek with raising their guidance. They're going to introduce further AI strategies that are going to get people excited and have people keep spending. But is the macro environment ultimately going to be the problem? I'm concerned it is.
All right, if you're concerned it is, Jim, let's bring you back in here. I mentioned before some of the caution that's now permeating through Wall Street on the strategy side of things. It's not everybody, by the way, that's saying that. So let's try to give you a little bit of the counterpoint here. In BMO's Brian Belsky, noted bull here, friend of the show, he's sticking with his 6,700 target price for the S&P, saying that fundamentals remain more green than yellow. They're disputing our view. Many of the growth scare headlines are there. The economy is showing no substantive signs of recessing. To state the obvious, recent stock market weakness is all about uncertainty, period. As such, there's time to hunker down on your respective disciplines, avoid reacting, and rely on facts over feelings. Also, UBS says there's still more upside left to go in stocks as well. In our base case, we expect U.S. equities to end the year meaningfully higher than today's levels, with a December S&P of 6,600. U.S. policy uncertainty could lead to short-term volatility, but we believe that continued structural AI tailwinds and solid earnings growth should drive markets higher once policy uncertainty peaks. That is also what's been happening for the better part of the last 6 to 9 months, outside of the last 2 to 3 weeks. So, Jim, which side do you err on?
I'm with Brian. He's a friend of the show and a friend of mine, and not just because we agree, but we do happen to agree. Simply put, the positives outweigh the negatives. Now, everybody listening, I want to be clear. There are substantial negatives out there. A trade war, tariffs are not generally positive for the economy or the stock market, but there are the substantial positives that both Brian Belsky and UBS are pointing out. And I would list those as we still have an economy that's still growing. I know there's this Atlanta Fed GDP thing, but we've got to adjust that for the gold arbitrage that's going on between London and New York. We still have an expanding consumption in GDP. We've got low unemployment, and we've got a Fed that still wants to cut interest rates. Lastly, and I don't think anybody's really talking about this, we've got a very stable banking system right now. Now, I hope like heck that I'm not jinxing it by bringing that up, but we do have a stable banking system right now, one that is willing to lend. You put all that together, and I submit to you that to me and to us at Cerity Partners, the positives outweigh the negatives. Our year-end price target on the S&P 500 is 6,400, which is, roughly a 10% plus return from here. I'm not a big fan of the price targets game because people tend to adjust them as the, winds of sentiment change. I think we're going to stick with that target for a while, though. We just see the positives outweighing the negatives.
And if I could just follow up 1 second with you, Jim, NVIDIA, because we framed it around NVIDIA as a catalyst this week. What are the thoughts there? This is a name that you are a part of.
Yeah, and very happily a part of. I think everybody has to understand there is no free lunch in investing. You don't get reward without risk. And the risk is volatility, which means that you get drawdowns like this. Another friend of the show, Adam Parker, has done some excellent research that says if you want to get 10 baggers like NVIDIA, you have to be prepared for routine 50% drawdowns, which has happened a lot in NVIDIA's last 5 years. I'm not saying that that's where we are now. I actually think that it's probably, Christina pointed this out, very attractively priced at 26 times forward earnings for earnings per share growth at 53% going forward. That's a PEG ratio of 0.5, and boy, I love that. So I feel very good about NVIDIA, but I'm going to close by going back to where I started. There is no free lunch. If you want the rewards that an NVIDIA brings, you have to be prepared for the risk and the volatility.
All right, Bryn, I want to bring you into the discussion as well because you have recently added to that position in NVIDIA on this kind of recent downtrend that we've seen short term. Take us through why and just why it is an important holding for you.
Yeah, I think Jim and I both added to it last week. So NVIDIA has been trading within a pretty tight band over the last 9 months between about 109, 110 to about 145. And so it got down there last week. And I feel that the fundamentals and the price of NVIDIA have completely separated, which happens. It happens on the upside. It happens on the downside. And so to Jim's point, they have very high margins. They're growing top line in the 50%. It's a cheap stock. And I think that AI will continue, and it's in the early stages. And if you talk to anybody in the data centers, anybody at the hyperscalers, none of them are saying we are going to build less data centers. None of them are saying we are going to reduce CapEx. All of them are continuing to spend, and NVIDIA, we know, is probably the highest margin recipient of all of those dollars. Now, to Jim's point of the risk, I think one of the risks and one of the clouds over the name are with the tariffs. This is a national security issue about the platform that they offer in China. And so there hasn't been a lot of saber rattling about that, which is good right now. I think that's one of the reasons the stock bounced with the market. But I think the market would sniff that out well before we would see that in print if there was going to be more extreme export controls on their products. So we'll have to wait and see. To me, that's the biggest risk. But once again, I first bought the stock in 2018. because there was some like Ethereum slowdown, and that's why most people used their chips at the time. And to Jim's point, volatility is the price of admission, but this to me is one of the most durable, cheapest of the tech names out there, and it's right in front of investors to take advantage of.